Morning, listeners. Welcome back to Almus Market Mornings with Shikhar Garg. And folks, it's Friday. So we shall begin by saying, thank God it's Friday. I mean, it's more legit looking at the way the markets have been performing. All a set of mixed bag data and also a mixed bag reaction. Take, for example, yesterday we got the update. Euro zone is in a technical recession, and what do we see? Euro rising against the dollar. Now, this is quite an interesting set of narratives that the market is following. Now, we are seeing strong payroll growth, which is in contrast with the manufacturing services and the other macro factors. There's only one very strong macro nation, which is India, and yet Indian rupee is not really strong enough compared to its previous standards. So, JK, I'd like to know how is this particular narrative going on, and what's to be expected in the coming days.
Good morning, Shikhar. First on the rupee, which did not get any inspiration from the monetary policy yesterday. It was almost a non-event for all the financial markets. Rates held steady, growth projection unchanged, and a marginal reduction in inflation forecast. In my view, all options are open for the policy for the next 6 months, given the uncertain global trends. One could not fault rupee traders' frustration with the narrowest range of 8.25 paise, marginally more than the 8 paise range we had on February 23 this year. What may perhaps excite traders would be that post that low in February, we had seen intraday volatility surging to as high as 43 paise in the next 10 days. So good wishes to the traders. Fundamentally, we await more clues from CPI data on 12th of this month for India and 13th for US, and all important FOMC decision on 14th. Of course, where the expectation of a skip got a further boost from yesterday's jobless claims data coming far higher than the previous and the forecasts. Job situation is showing definitely something softness that would some hearten the Fed, no doubt. Now, the global markets had thrown up global economy threw up two important indicators. As you said, the Eurozone got into a technical recession. Now, while one might argue that it is a backward-looking data, even the growth going forward does not promise better despite drop in wholesale energy prices, as monetary policy tightening dents investments and the still present inflationary pressures constrain consumption. And as we have seen, the recent data is also not showing any improvement. Therefore, the outlook for Q2 of 2023 is not so great. So I wouldn't bet on Euro continuing its rally on the basis that it's a backward-looking data. But Euro was always looking for a bounce on short covering after having failed to penetrate 1.07 on a sustainable basis. Yesterday's rally in the Euro was definitely something of a short covering, but I feel 1.08 is going to give a very strong resistance. Now, the other event was jobless claims rising to 261,000, expectations 235,000. It did have some impact on the markets. Further signs of jobs softening formed up expectations of a hold by Fed next week. 73.5% probability was 65% before the data, leading to fall in yields and the dollar, and a small boost to the stocks. 2-year yield fell by 3, 10-year by 7, and 30-year by 6 basis. Not a very significant move considering the data. That also means the supply overhang of fresh issuances by the Treasury is definitely having some impact. The global composite index of liquidities rose 0.5% and hit the resistance which it has held for the last 3 times in the last 6 months. Now, the US indices improved 0.5%, with Nasdaq gaining more than others at 1% plus. But interestingly, after recovering 20% from its October lows, the broader S&P 500 may be on the verge of entering a bull market, which next few days price actions will confirm. But one really cannot draw a definite conclusion because we have a prospect of a global recession, and monetary policy is still continuing to be tight. And in terms of dollar, euro recovery was more than matched by yen recovering 0.9% and GBP with even more 1% gain. Even the Chinese one, which had hit fresh 7-month high at 7.1555, saw some profit taking from the players, having weakened more than 6.5% in 4 months. Now, a lot of bad news from the economy seems to be in place now, and in the price now, and the most EM currencies also recovered modestly. But The standout underperformer has been the Turkish lira, which has lost 18% in the last 20 days and by 13% in this week alone after Erdogan got re-elected as PM and the central bank started defending defending its currency. The other big news story overnight is oil, with WTI crude off $2, which is over 71, and Brent at 71.50. Brent down 1.50, following some media reports saying Iran and US may have made progress in talks over Iran's nuclear program. A deal would, on some estimates, potentially see an extra million barrels of oil added to global supply. Now, anyway, other agencies are reporting that there is no such confirmation of progress in the talks. Then RBI, apart from the monetary policy, there's also news that 1.8 lakh crores worth of 2,000 rupee notes have been returned so far out of the estimated 3.62 lakh crores in circulation. That is indication of the amount of liquidity that is flowing into the Indian monetary system afresh, and definitely RBI's continuous VRRR operations are intended towards sucking out this excess liquidity, which may be fueling inflation if it is not done. Now, the next week we have policy meeting of Fed, BOJ, and ECB, and their statements, rather than the rate decision itself, would provide a lot of inputs to the digest for the markets, particularly in terms of what we should be expect going forward. Thank you.
Okay, JK, that was quite good. And yes, folks, I mean, looking at the kind of debt volatility in USD INR, the traders for USD INR are already having difficult, not actually difficult, but an interesting time to, or a lot of spare time to think about other currencies to trade on. Any which ways, the central bank is having all its options open for the coming MPCs and might take their cues from the global actions which are to be seen next week onwards again. There was a small bounce in the euro that we were seeing, and as JK mentioned, it can probably be basis the short covering of the so much short positions created over the coming weeks. But if we have to talk about the macro performance, yes, Q2 growth would be concerning. But on the other side, do we see market participants really keen on the concerns? It's a good question, because the equity indices are showing bullish sentiments, and even with a tighter market conditions, we've seen equity indices rising quite well. Japanese equity markets, as we all are aware, has been performing quite well, even being joined by the US and the Indian equity markets. Now, oil, as JK mentioned, has dipped for the second straight week, but there are many discussions around a possible deal between the two nations, which can only add to the supply, whereas there has been discussions of a possible cut in supply to offset and increase the prices. So there's quite a bit of mixed actionables that are visible in the financial markets. I hope you guys are keeping a track while we continue to bring in all the latest updates for you. That's it for today, folks. We shall come back again next week. Thank you so much for listening.